Welcome to the Phil Vogel podcast, where we talk dealership mergers and acquisitions, as well as all the other elements affecting dealers' operations, trends, and technology. So if you like what you hear or see today, please hit the subscribe button below. And if you don't care for it, well, hit the subscribe button anyway. Today's show's sponsor is Vogel Strategies. Vogel Strategies is the boutique automobile dealership mergers and acquisitions firm based at the tip of Silicon Valley on the San Francisco Peninsula. Vogel Strategies does little to no marketing, but rather relies upon their reputation of getting deals closed, clear lines of communication, and managing expectations, as well as over-delivering superior results for their dealers. VogelStrategies.com. Our guests for this show are Cliff Banks and Steve Greenfield. Both Cliff and Steve are well known to our industry. Cliff is the founder of the Banks Report, where he provides analysis and insights to the automotive retail space with a focus on OEM and vendor brand and strategy, retail technology, as well as dealership acquisitions. Steve Greenfield is the CEO and founder of Automotive Ventures, where he specializes in assisting automotive technology entrepreneurs fundraising while also providing transactional guidance. And he recently closed a $7 million fund to invest in automotive technology startups. He is prolific on LinkedIn and with his news and analysis of our industry. So without further ado, I give you Cliff Banks and Steve Greenfield. Welcome, gentlemen.
Thanks for having us, Phil.
You bet. How's everybody today?
Good.
Doing great here, Phil.
Excellent. So let's just kind of get right into this, fellas. Is this the year, the COVID year, where all the trends and strategies changed for car dealers? It's been disruptive, to say the least. There's good news and bad news, but certainly COVID has accelerated a lot of different trends. And I'm curious what your guys' take is on this. Let's start with you, Cliff.
Yeah, it certainly has changed a lot. I think there's an era of uncertainty still. I think right now the impact that we're feeling is the chip shortage and the questions surrounding how long is that going to continue. And that actually may even have more of more of an impact than what COVID will have long term, possibly. We'll see.
Right.
But, the chip shortages very possibly could change how automakers approach manufacturing and sales. I mean, both Ford and GM's executives, our CEOs, have been very clear in saying that they are pushing their companies to be more customer experience focused and less focused on the sales and transaction model that they are today, which means fewer products in the market or fewer vehicles into the market, I guess, because up to now, it's been more of a sell it or build it and sell it. And that's an incentive-driven environment, and they want to move away from that. We'll see if they're able to, long term. But
Steve,
talking about this,
what do you think? What do you think, Steve?
Yeah, I mean, I'll echo what Cliff said. Just a year ago, where we had this convergence of auctions being closed, many dealerships being closed by state regulators. And, every dealer in the country raised their hand and said, look, I need to figure out how I'm going to sell cars online. And then we had these weird dynamics last year with more demand than there was supply, which drove up used car prices. And we have now another peak where we've got the shortage of new cars, which is driving up used car prices. And now we've got a shortage of not only new, but used cars. So I would say, Phil, I would answer your question is, shame on the industry if they don't take the last 12 months as good learning opportunities for the future. Dealers have now printed 3 row of record profitability, like all-time record profitability. The OEMs as well are printing quarters of like all-time record profitability. Having a resilient, U.S. consumer who's still buying and servicing their vehicles while inventory constraints, I think we should have all learned something. Dealers should have learned how going forward they can operate with fewer employees and fewer costs. The OEMs the same. And if the OEMs do go back to the old like overproduction and then pushing cars into fleet and then over incenting cars, shame on them. But we should come out of this hopefully with both OEMs and dealers learning something about suppressing their cost structures and just doing business differently going forward.
Yeah, I think that's a great perspective. I was going to ask this question further down the in the podcast, but I might as well ask it right now. One of the things, what do you the dealers have their framework agreements with the OEMs, and Cliff touched on it a little bit about the focus on the customer experience, and I'm wondering, because I've been involved in a few deals of late where these framework agreements come into play. And certainly on the large deals, the Lithia acquisition, keys, there was, certain deals need to be spun out because of framework agreements and what have you. But we see it around. And what do you have any thoughts on those framework agreements in terms of, and just for our audience, those that don't know what framework agreements are, it's really an agreement between a dealer group and a particular manufacturer, specifically what the relationship is, the number of stores they can own in various markets, et cetera. So any thoughts on that?
Cliff knows much more in this area than I do. My perspective is, you introduced Lithia as an example. Let's talk about Lithia for a minute, right? I mean, I think that historically the OEMs have somewhat been hesitant about market concentration. So they've looked at the large dealer groups and said, look, we don't want, in some cases, a dealer group, one particular owner to own too many physical stores of ours and try to moderate some of that. And I think that there's a new era, I believe. I mean, this is going to be changing. I think that the OEMs are going to embrace the fact that a Lithia, as an example, is a really good operator. They have great brand integrity. They're very, very efficient and are good kind of stewards of these brands. So I think that, what we've known in the past in terms of, framework agreements likely is changing very quickly. And I think going forward, the OEMs are going to much more want to align themselves with what they perceive to be kind of the winners in the space. And I think Lithia would be a great example of one where, they'll have much more flexibility and we'll be moving away from these rigid framework agreements going forward.
Yeah, I think you make a great point. But I also think, aside from the framework agreements, I think I had a conversation in the last month with two different OEM executives who will remain nameless, but both of them, the conversations, we were together in person, and both of them felt that this was an opportunity to really reshape the industry. And what that means from the OEM perspective versus the dealer perspective leaves to be seen. But that said, I think that but the conversations we had, it was around the customer experience. It was around, framework agreements a little bit, and is also around corporate image, the CI
Right.
requirements. And I think that's going to be something that most OEMs, I think we're in agreement that there's going to be a real opportunity to reorganize this business, and I'm hoping that it's for the positive for all involved.
Yeah, I mean, you say that, though. I do think there's more consolidation coming. I think it'll be harder and harder as a single point operator to be relevant. And not to say that if you've got a single point in a big, dense urban area with a good brand, yeah, I mean, you'll be fine standing alone. But I think in some cases, it's going to be really, really hard. The dealers that are going to be more aggressive with buying up locations and then really consolidating the back end are going to find themselves just having healthier profits overall. We're going to come out of COVID, and I may not be popular for saying so, but we're going to get back very quickly, I believe, to the dynamics that dealers were facing prior to COVID, with margin compression on the front end. I think, the transparency that inevitably is going to come to the back end, the trade, the financing of the cars, and then the insurance products, transparency will come. I mean, part of it will be driven from some of these online players like Carvana, Shift, and Vroom, where consumers will see very transparently, what an extended service contract is for a given car. But I think that just by the nature of the internet, it's brought transparency to every single vertical. just look at Amazon and how much transparency consumers have on any consumer packaged good they buy on Amazon now. And the transparency the internet has brought has not been friendly to dealers on the front end. It's really the primary reason that the margin's been driven out of the front end of the car deal. And I think post-COVID, when we get back and we kind of re-equilibrate around inventory, both on new and used, we're going to get back to like these great consumer experiences. The consumer is going to be more armed than ever with data, and the dealers are going to get squeezed. And I think it will then favor the dealers that are able to go out there and buy stores at a reasonable multiple, the world that you live in, Phil, and then consolidate back end functions such as marketing, accounting, HR. And there'll be an advantage to dealers that are able to consolidate. And I think if I've got a poor brand as a single point, it's going to be really hard for me to stay relevant.
Yeah, I agree. I think you nailed it. That was great insights. You mentioned some of the Carvanas and Vrooms and Shifts of the world. So let's talk a little bit about M&A deals in the tech space. So what, from your perspective, Steve, the last 6 months, what are the top two tech M&A deals in your opinion, and why?
Well, I mean, there's been a lot of heat lately on the sort of digital retailing space. Roadster sold to CDK, and here last week, Gabagoo sold to Reynolds. But I mean, I think those aside, because there are big implications there, I would say the theme that I'm most interested in tracking is kind of what I've been talking about, like this blurring of lines between retail and wholesale. And the best example probably is CarGurus bet late last year on CarOffer, right? So CarGurus competes with the likes of AutoTrader and Cars.com and TrueCar to get consumer eyeballs on one side of the marketplace and then connect those with dealers' inventory on the other. Well, CarGurus made a pretty bold move with the majority investment in CarOffer to help dealers with more of what I would say is a holistic used car solution. So now, dealers who use CarGurus can use CarOffer, one, to source cars, to make sure they're stocking the cars that are going to better address consumer needs on sites like CarGurus, but also dispose of cars. So if they attempt to sell cars on CarGurus and that doesn't work out, they can now dispose of them without having to go to the auction, right? So you see these big consumer marketplaces like CarGurus starting to get into and encroaching on what was historically a clean line between consumer marketplace and B2B marketplace, or the auctions, which, by the way, the physical auctions are also getting attacked by startups like ACV Auctions that just went on public as well. So that's one example, the CarGurus CarOffer. And then in the same vein,
not to interrupt you on that, we had Bruce Thompson on the show a few weeks ago from CarOffer, and we talked about that.
Sure.
What a phenomenal transaction for him and the whole CarOffer team. But really, to what you were just saying, I mean, the way that, because we talked about why that deal came together, and the value add for both was tremendous.
Yeah, no, agreed. And then a mirror image of that, I would say, in the same sort of vein is Carmax, interestingly, buying Edmunds. And at first blush, you look at that and you're like, wait a second, Edmunds was historically known as a new car upper funnel shopping experience where consumers very early in the new car shopping process would get on, see reviews, see editorial, and start to make decisions around which minivan do I want. And then you've got CarMax, which has divested itself fully of all the new car stores that they used to have. It's a used car store only, the largest retailer of used cars in the U.S., and they buy Edmunds wholly. So I mean, it's a bit puzzling. But at first glance, you look at it and say, what does CarMax need? Well, CarMax sees clear and present danger from the Carvanas of the world getting traction, and they need more of a significant online presence, right? CarMax has to position themselves in the future to the consumer much more around and aligned with the Carvana value proposition. That's one. Two is they need to get a source of inventory. Even pre-COVID and before we had these shortages on used cars, I mean, one of dealers' primary challenges is getting a good quality source of used cars. And they can provide their sort of guaranteed trade-in offer to Edmunds buyers. But it's very interesting when you have the largest retailer of used cars in the country buy an online third-party marketplace. Yet again, what were historical partitions and barriers are now starting to get broken down.
Right. I think you nailed it. I think, but he has some great insights as to that Carmax deal. It'll be interesting to see what comes out of that acquisition, the Edmunds deal, right? I mean, it's going to be very interesting to see what they have in mind and where they think the value add is for them. So when you look at looking forward, what potential automotive tech M&A, other additional deals do you see happening maybe this year or the first part of next year? Or what's
so there's some big deals in the hopper, which isn't surprising given where valuations are. We've got a really strong stock market that's helping support really good private company valuations, and then a lot of private equity money out there looking to deploy. So I think we're going to see a continued very healthy M&A environment, both in the physical dealerships, but also the automotive technology. So and we'll see a couple of really big deals this year. I think that, I speculated at the beginning of the year that at some point here, Reynolds and Reynolds has to be in play, very publicly, and not to get into it, but, if you just do a search for Bob Brockman, you'll see sort of like the negative press that he has out in the market. And, that's got to also provide some uncertainty around ownership going forward. And I suspect, that's still a primo asset when you look at sort of like the two big players in the DMS space being CDK and Reynolds. I mean, the owners of Reynolds must be sitting here and saying, is this the right time to be doing a transaction? And that's going to be a very, very big transaction if that one gets done. And would love, when Cliff gets back on here, if we're able to ask him what his perspective on a Reynolds transaction. But I mean, I don't think anyone would be surprised if we saw a Reynolds transaction this year. And then the other big thing that is loitering. When you
say Reynolds transaction, are you saying like a sale of Reynolds?
Yes. Yes.
Yeah.
I kind of went on the record in January to say that was one of my guesses for a big transaction that would happen this year. I mean, I think it's inevitable it happens sometime. Whether it happens between now and the end of the year, we've only got 6 months left. But I do think that one's got to be. I mean, there have to be people in Dayton starting to think about that, and I'm sure the investment bankers must be circling.
Yeah, I think you're right.
So
yeah. I just think that the Reynolds, to your point, we've discussed it at some length on this show with different guests, and you mentioned the Brockman. It's just tainted. So it's got to go. Something's going to give there, right? If you're especially from your point around the other investors, right?
Agreed.
A question. You are so in tune with kind of the SaaS or the software companies that are the startups. So tell me is there a particular startup, whether it's SaaS or used car provider or other newcomer that you are kind of has caught your attention?
Well, I mean, we're kind of uniquely positioned to see a lot of early stage stuff now, right? So we just launched the fund. We've made, as of this morning, nine investments. So we're investing, and we're putting really small check sizes, like $100,000 or $200,000, into very early stage automotive tech companies. So our doors are now open, and we're getting a lot of inbound interest. So we're seeing a lot of things. But I'm probably most intrigued, for the benefit of the audience here today, in finding technologies that are going to help dealers kind of weather the storms coming in terms of like margin compression, right? So one of the first companies we invested in is a company called Warrcloud, WARRCLOUD. And what they're doing is they're helping dealers process the warranty claims in their service department and saving money as a result. So what was in the past a rather painful and clunky experience where they would either have a clerk and or they would outsource it to sort of a mom and pop shop. Now they can, basically run it through Warrcloud, which is a software system, which allows them to make sure the claim gets submitted correctly to the OEM, they get paid quicker, there aren't any errors, and save money in the process. So I think it's just a good example of technologies that are out there and have to emerge in the future to help dealers operate more efficiently and get more done with fewer people, but also, you know, just some of these historical manual processes that we've seen in dealerships have to get automated. And it's an area of our sort of like investment thesis that I'm really excited about exploring.
Yeah, I had not heard of Warrcloud at all. But boy, oh boy, as a former dealer and, guy that does M&A with dealers all the time, that is a legacy. I call it a legacy business, right? Kind of the file cabinet, let's pull this
Right.
out of here. I mean, so let's talk about Warcloud just a little bit more in depth. That is a compelling model. So I know, some of the issues around dealers and warranty claims. I mean, yes, it is a clunky kind of old legacy business. So I can imagine. I used to say that FCA, or then Chrysler back in the day, used to really finance their business on warranty and incentive audits, and
Right.
because they were so onerous and what have you to their dealers and what have you. But I could see where the compliance component of So can you talk to that a little bit? I mean, do you know enough about that to address it?
Yeah, I mean, clearly, you know, if you're going to be submitting claims back to the OEMs, they have to abide by all of the OEM's rules, right? So there
Right.
aren't ever any issues where they aren't in compliance, and the audit trail is always there. It's all electronic now, so it really helps the dealer, one, cut labor costs out, but also, to your
Hmm.
point, you know, removes errors, make sure you are in compliance, and gets the whole cycle of getting paid quicker.
It's interesting. So, yeah, I love that. And it takes the open RO issue to a whole new level. One of the other things I could see where is, I used, having been through different audits myself, I always wondered, sometimes, you go through the audit and they're telling you all the things that you did wrong and the chargebacks that they're going to impose or want to impose. But yet they never, I always said, okay, so you got all the debits. So where are the credits of the audit? Like,
Right,
what?
right.
Well, it's an audit, right? It's an audit, right? Well, yeah. Well, so audit means balance. And so if you're checking this to find out where, we did something incorrectly and you're going to debit us, where there's bound to be instances where we did things correctly, but we didn't take credit for it. So anyway, I can see where that might go. That's interesting.
I don't think that
That
works
sounds
with
like
the
a
IRS
company-wide.
either. Yeah.
Right. Absolutely.
Yeah.
Absolutely. So let's talk a little bit more about your fund. I think that's it's compelling. And I think that, while we've seen a lot of startups in the space, what's your overall vision for the fund? And you just kind of tell us about that a little bit.
Sure, sure. Yeah, so I've been in the auto industry for about 20 years and, you know, have had a chance, thankfully, to interact with all kinds of entrepreneurs across the spectrum from, you know, very early stage to guys who are, you know, have just had exits and have done very well for themselves. And one of the recurring themes that we've seen is the fact that there isn't a lot of like very early stage capital. You know, there's a lot of like private equity and VC folks that once a company's got some traction and they've got a bunch of revenue coming in, it's kind of de-risked. So we're trying to
Right.
hunt very early to find these entrepreneurs that may have no revenue and customers yet, or may have their first handful of revenue and customers, and help them not only with, you know, some money coming in the door, but also help them make connections and get introductions, et cetera. We've got about 70 investors who have invested in our fund, 15 of whom are dealership principals who have
Mm.
multiple dealerships. So we can instantly turn that on and, you know, get a vendor into stores right away and get them testing it and getting testimonials, and then they can share it to their 20 groups, et cetera. But
Right.
we've also got a lot of automotive tech entrepreneurs who have had exits. So, you know, over the years, I've come to know a lot of these folks, and I'm very appreciative. They've had faith in me as a first-time fund manager to invest in
Right.
our fund, and, you know, they really like it because, one, they in the companies we're investing in, but also, I mean, I can bring them in a mentoring capacity to really help energize growth, right? So this this
Kind of like
idea about
similar
investing
to
in.
it. Yeah, similar to an executive in residence.
Exactly right. Exactly right. So I think that it's a great benefit to early stage companies to consider taking money from us, because we aren't just dumb money that's going to sign them a check. We really will help introduce them to people in the industry, introduce them to dealerships that can test out the technology, get them connected with entrepreneurs who have had successful exits in the space so they don't stumble and they don't run into roadblock that they would otherwise hit. And then the flip side, I think for our investors, it's exciting for them. A typical case is, I'll talk to a dealer principal and they'll be like, I really like investing in you for two reasons. One is, I can get hands-on and I understand what you're investing in. But also because, we're only putting in a small check size, in many cases, these folks can invest alongside us. So, we put in 100 or 200,000 on 5 of the 9 deals we've invested in so far. Our LPs, our limited partners, the investors in our fund, have co-invested alongside us. So we're trying to really structure a win-win here and get outsized returns for the LPs and get really, really good outcomes from the companies we're investing in.
I think what you're doing, Steve, is so smart because you understand this space. And so many, it's a typical venture model, but a friendly venture model, right? Where your investors, the LPs, can decide, co-invest alongside of you. But I love this. I think it's a great idea conceptually, but also to your point around having these executive in residence potentially, and also, SEMs, subject matter experts, where you can bring those people into the loop that have been there, done that with your new startups. And because you're not a generalist, and because it's very specific in terms of automobile software, I think it lends itself to, I'm surprised, was your fund oversubscribed?
It was. We had a $5 million target and we came in at $7 million, which by all indications is a really small fund. But no, I was very pleased that we came in oversubscribed and had a lot of interest. Like I said, we've got 70 folks who have invested in the fund. So I'm very pleased and very appreciative of their support.
Yeah, I think that you're on it. That's very compelling. I can see where that, your next fund could probably be starting that relatively, maybe by the end of the year, maybe, you think?
Well, I figure 18 months, and we'll have burned through this initial capital. I think for a $7 million fund, we'll probably end up making 25 investments. We've made 9 so far. So, we'll keep up a pretty good pace here. And, probably sometime in the next year and a half, we'll start thinking about fund 2.
Great. So let's talk about SPACs. So for those in the audience that have not heard of the SPAC, I'll let Steve describe it a little bit. I mean, what SPAC is an acronym for Special Purpose Acquisition Company. And so I think, I've been involved in, been aware of SPACs for about 10 years now. And I always thought that it was an interesting, compelling business model and wondered, and there were a lot of failures and kind of deals that did not do well many years ago when SPACs initially came on and the regulators were questioning a lot of things. But we have seen a flurry of activity in this space when it comes to not just automotive, but let's talk a little bit about the SPACs and how it all works with automotive, software and startups.
Yeah, I mean, so they have, to your point, Phil, I mean, this concept has been around since the 90s. And, originally it was like a blank check corporation or a shell corporation where you'd literally take a company public that didn't have any assets other than just cash. And then you would use the opportunity to go find a private company to buy it. And there would be like a reverse takeover where that company then would inherit the public listing of this shell company that was already public, but only had cash on the balance sheet. And, it has been a sort of like a flavor du jour over the last 18 months. There have been many more SPACs than there have typical IPOs. And that's for a few reasons. One of which is a fast path, right? If I have a private company, I can get one of these SPACs and get partnered with them and de-SPAC and become the public company within a few months. So in terms of speed to market, it's quicker. Number 2 is there's a lot less red tape. And that has come back to haunt SPACs. If you've been following the press, there maybe should be a little bit more regulation and red tape, and the SEC has stood in. And then the other thing, most importantly, if you look at any of these SPAC presentations, and I've got a bunch of these presentations now on the Automotive Ventures website because I figured people would want to see them. So if anybody wants to see any of these decks, I've been collecting all the automotive and mobility related SPAC decks. So you can go to Automotive Ventures and see them. And one thing you'll notice is they all project 5 years. When you have a traditional IPO process, you are not allowed to have forward-looking forecasts, period, full stop. With a SPAC, I can have a SPAC and like these electric vehicle manufacturers, and then project out that in year 5, I'm going to be generating $100 billion in revenue because I'm selling all these cars. Well, it's unfair for an unsophisticated investor who looks and says, oh, okay, so I'm looking at the SPAC presentation, seeing $100 billion of revenue. It's like, okay, I'm going to invest. One of the reasons that IPOs cannot forecast out is because they don't want to mislead investors and have them gravitate towards these long-term goals, which may or may not ever play out. And I think that combination of like being a fast path, little to no regulation, and having these forward-looking financial models that aren't permitted in IPOs has gotten some of these SPACs or the companies that have gone public via these SPACs into hot water. And you've seen, I won't mention any names, but we're seeing almost weekly some of these EV manufacturers that are either, may not ever produce a vehicle and have had billions and billions of dollars of market capitalization, or may run out of money. And there may be a huge down round in terms of valuation when that company has to go raise money because they just didn't raise enough money to begin with to actually get a car produced. And it's sad, but it's just to your point, it's like, it's a sign of the times. Things are really frothy. In a world where, daily we see Bitcoin and Dogecoin and we see, NFTs and all these things, there's a lot of money and speculation going into the market right now. And, I think things are frothy. Whether that froth will continue, nobody really knows, but things are definitely frothy right now in the market.
Yeah, no, I think you did a great job explaining what a SPAC is and also the pitfalls and benefits of it. I keep waiting for a SPAC roll up of franchise new car dealerships. With a group, I'm waiting for that. Have you heard anything on that front at all?
I haven't, although I've heard there may be a transaction between now and the end of the year with something going public, but it may very well be through a SPAC. I'm not certain if it'll be more of a traditional IPO process or a SPAC, but if I had a private company right now and I wanted to go public, the best path is through a SPAC because it's a lot easier, a lot less red tape, and faster. There's a lot of negative sentiment, but through this process, we'll look back and there have been a great number of really great private companies that have gone public over the last 18 months via SPAC, and we can't paint all of these SPACs with the same paintbrush.
No, absolutely not. And I think what's unique about the SPAC, and you talk about kind of the process of a management company going public with no assets, and then that company, basically what people are doing are betting on management. The traditional SPAC was sometimes they didn't even know what vertical they were going to go into. And this when you talk about SPACs as it relates to automotive technology companies or dealership, I think that the ability to bet on the jockey, in this the management of the company it's a very unique one.
Yeah. But we'll see more. Unless things slow down, there's no indication. And also keep in mind, there's something like 200 of these public shell companies that are out there right now hunting for private companies, right? So, and the other thing that I didn't mention is when one of these companies goes public and starts hunting for a private company to de-SPAC, they have 24 months. So the clock is ticking for all these companies. So there will be a whole bunch more of private companies that go public via SPAC over the next 18 months because there's hundreds of these SPACs out there hunting for targets right now.
Exactly. Great point. I'm sorry that we lost Cliff, Steve, but I got to tell you, I hope that we can do this again. I'd love to we'll get Cliff back on another time, and but I would love to do this maybe towards the end of the year or the first part of next year and kind of recap, see how we did
Sure.
with our insights, right? The crystal ball, but also be kind of do a look forward if you guys are agreeable to that.
Yeah, I'd love to. I mean, I think that not enough people in the industry try to forecast out what's going to happen in the future. And I think we should, make some gambles here, because I think that, there's a lot of change coming to the industry any way you slice it. It's an exciting time for all of us to be in the industry. And man, we are going to see a lot of change and a lot of M&A activity. There's no doubt.
I think you're absolutely right. I can't thank you enough, Steve. And thank you to Cliff. I'm sorry that Cliff got froze up and what have you, but we will get him on next time. But Steve, before I let you go, please tell our guests and audience how to follow you or reach out to you. What's the best way to connect, socially or analog?
Great. No, thanks. I mean, reach out to me on LinkedIn. I try to post as regularly as I can, really relevant content for the industry. Go to automotiveventures.com and sign up for my newsletter if you get a chance. And I'm open to positive criticism around things I should cover in the future. But I try every month to cover good content that's really relevant to folks in the industry and publish that every month.
Great. Well, Steve, thank you so much. Appreciate it. And we will look forward to having you and Cliff back at the end of the year or first part of next year. And so until next time, everybody, thanks for joining the Phil Vogel podcast. We'll see you. Bye-bye.